Ladies and gentlemen, please welcome your moderator, Executive Director of the Milken Institute's Center for Financial Markets, Staci Warden.
Hi, everybody. Thank you so much for being here for the absolute best panel of the 2017 Milken Institute Global Conference. I've got an all-star cast up here with me, and they have very generously, I would say, offered to put up between 15 and maybe 20 minutes for questions. So as we get nearer to the end, please do kind of start getting ready, and we'll leave time to ask some questions. So I'm not going to do a lot of prep and intro because we have a lot of material to cover. I'll just do some quick introductions. None of them, I think, need introductions, but Mike Arougheti, who's the president, of course, of Ares Management. Mary Catherine Dubois, who is the head of asset-backed finance at Wells Fargo. Damien Dwin, who is the co-founder and also president of Brightwood Capital Management. Nino Fanlo, who is the CFO and president of SoFi. And last but certainly not least, Terry Harris, who is the head of portfolio management for global private finance at Barings. So this panel is about the mid-market, and it's about direct lending. So can I just kind of go down the line and have you tell me what is direct lending for you, and what is mid-market for you, and where do you play in the ecosystem? And Nino, and for you, just talk a little bit about your business model as well and how you're a direct lending player. So,
sure. Afternoon, everyone. Staci, thanks for having us. We try not to pigeonhole ourselves as we think about the definitional constraints of direct lending or middle market, and I think generally, we just like to think of private credit and illiquid credit as large global addressable markets for us. So for us, that means lending to corporates, lending to real assets, including real estate, infrastructure, power and energy, and it means doing so in asset-based or asset-backed forms of financing or cash flow. And the reason I say that is 20 years ago, which maybe we'll tease out, that the market was much more narrowly defined in terms of what was available to non-bank lenders, how investors thought about allocating to the space. So our thinking around what's available to us and what's available to our investment partners has grown quite substantially. So today, Ares manages about $100 billion of assets under management. About 2/3 of that is in the credit business, and about $40 billion of it is in these broadly defined illiquid credit assets. And so for us, it's anything from lending money to a pre-revenue or pre-cash flow venture company all the way through to a quasi-syndicated loan to a private equity-backed company. And I think what we're seeing is the boundaries of the business continue to expand as capital is flowing into the market and new products are coming to meet the demands of the borrower. So we have a very, very broad definition of middle market and direct lending.
And Terry, is that how you think about it as well? How would you think about direct lending, and also what role Barings plays in this?
Yeah, sure. So Barings is a global asset manager with over 270 billion in assets under management across an array of asset classes. We're certainly very well known in the liquid loans and bonds side, but we think that private credit actually is a natural complement to the more liquid fixed income business. And for us, private credit can certainly span from traditional corporate private placements to infrastructure. And for my group, global private finance is involved in direct lending to companies that just aren't large enough to access the broadly syndicated loan and bond markets. And so if you think about in the US or in Europe, that's typically companies with say 10 to 50 million in EBITDA. And in Asia Pacific, where we focus to a large degree on Australia and New Zealand, but also in other developed parts of Asia, given the relative lack of depth of the capital markets there, sometimes the companies can be much larger, and we can find private opportunities that are attractive there as well.
Damien, is that the same thing for you? Is that your model?
Very different.
Oh, yeah?
Very different. So we are fortunate at Brightwood to serve primarily family, founder, and entrepreneur-owned businesses.
Okay.
So the key point of differentiation for us is that we actually try to avoid private equity guys.
And I think I'm supposed to leave the panel now.
In so doing, there's, as we see it, $1 trillion of opportunity in the United States alone to satisfy a thirst from successful families, founders, and entrepreneurs to receive non-dilutive capital. And we try to meet them more than halfway by giving them debt that is flexible. Our platform was started by two entrepreneurs, myself and Singal Selassie, with the vision of bringing public pension fund and high net worth dollars into this equation of disintermediating banks. And so our borrowers tend to have EBITDA below $50 million because in that lower tier, we're not competing with banks or larger direct lenders. We also know that we are able to satisfy a need from the families to have a single lender who can write a check for up to $200 million and execute. So we built the business over the last 7 years. We now have $4 billion, 50 people. We have 4 or 5 offices around the country, but it starts and stops with serving families.
So Mike Arougheti, Damien is saying that you're just kind of free riding on the due diligence of private equity firms and going to play golf at 3 o'clock in the afternoon. Is that fair?
Well, I usually tee off in the morning, but I think it is interesting because you just had 3 questions posed to 3 people with what I think would be considered to be successful direct lending businesses, and you got 3 somewhat different answers. Maybe stating the obvious, in the word direct lending is direct. And so I think what we all have in common is we talk about disintermediating the banks or replacing the banks. Really what direct lending is, regardless of the asset class or the market, is building local origination capability directly to the borrower, where you're not buying agented paper or intermediated paper, whether that's direct to families, direct to corporates, direct to private equity sponsors. And no, we're not, we believe in the private equity lending business for a whole host of reasons. Mike was talking earlier in his speech, which I thought was fascinating. When you look at the top 10 private employers in this country, 8 of them are actually private equity-owned companies. And so if you ignore the role that private equity is playing in the middle market economy, I just think that you're missing a big opportunity. They are repeat borrowers. They are very sophisticated operators. They have access to all sorts of flexible institutional capital. They have the ability to attract and incentivize management in a way that non-institutionally owned companies can't. So from a risk management standpoint, we would never just lend to a company because a private equity firm is buying it, or think of the loan to value in reference to their purchase price. But we do believe that with the right sponsors in the right situations, it's a much better risk proposition and represents a very significant part of the market.
How disintermediated are you feeling, Mary Katherine?
Well, it's interesting. As Wells Fargo, we were not traditionally a large player in the cash flow and leverage loan market. So speaking as Wells Fargo, not very. And the way we've been able to build, our scale, to be quite candid, in this direct lending market has been through partnership with many of these originators, not only on the stage today, but across the market. Mike referenced the market and what it looked like 20 years ago. That's really when we began building our lending product to finance what was probably more of a finance company or a very early birth of the BDC market, and has become a much larger scale asset manager model as Ares and Barings and others have built today. And so where we were able to look at our balance sheet, and of course many things changed, leverage lending guidelines came about, et cetera, but we were able to say, as a principle, we didn't love this asset class from a cash flow leverage loan perspective, but as a financing or an investor, for lack of a better term, at the senior level of the capital structure, and being able to use our corporate credit underwriting capabilities and get very comfortable with what the underlying collateral was, we could attach at a 65, 75% advance rate against these assets and build a really nice business. And we like what's happening, we like the growth, and while at the same time we believe that it still falls correctly within the regulations and what's being asked of the banks today in this asset class.
I would think that the ROE on that business for the banks is far superior than owning the whole loans directly. which I think is something that, when you think about the evolution of the business, we haven't displaced the banks. I think we've all settled into a part of the market where we're actually living symbiotically. If you think about general facilities provided by folks like Wells, 2-to-1 or 1-to-1 leverage, so 50 cents or 75 cents of every levered loan dollar is probably coming from the banking system, but it's coming with much better proximity to the collateral, much higher ROE, much less regulatory oversight, and much less infrastructure against it. So it feels like it's settled down in a win-win partnership type situation, as opposed to folks like us coming in and effectively displacing the banks.
And I think you're right. And then as you go back to the point made earlier around the number of portfolio companies that you then touch, right? We actually have bank products that we can think about working and partnering with you and others like yourself around the products that you don't want to provide, right? So then the bank is able to lever those borrowers through relationships in a unique way that you're not looking for cash management or treasury management or P cards and whatnot. So I think it's become a very interesting relationship to the middle market borrowers, which are so critical in the economic growth that we've heard about today frequently.
But I had Steve Sugarman on this panel last year from Bank of California, and he said, basically everything that you said, but he said, the math just wouldn't make sense for a bank your size. It's really the opportunity is really for regional banks, and once you kind of pass that systemically important threshold, you can't really make it work. So you only have about 75% market share, so what do you have to say for yourself?
Well, I was about to say that we've only grown the book about 20% year over year, so hopefully it's economically making sense for the institution. I think it's at Wells Fargo, we've built a business around this, right? And in talking about how that direct lending has expanded over time to pick up real assets, to pick up infrastructure. In some cases, you've seen the private equity firms become asset aggregators across residential, commercial, corporate credit. We've really built our asset-backed finance business around our clients, right? And building the financing products where we can start bottoms up and provide value through a very attractive, protected loan. So it sits on the balance sheet at Wells Fargo as a loan. And from a capital perspective, it's an extremely attractive risk-based capital asset. And so we have lots of room for that.
Okay. Nino, I feel like banking regulation kind of came along, and these guys stepped into the void in order to kind of fill a need for credit that banks were no longer playing a role in, particularly after the crisis. Whereas you systematically decided to kind of go after banks and go after bank business and disintermediate them. And so can you talk a little bit about the approach of SoFi and where you think you're bringing direct lending to the retail side?
Okay. So first, thank you, Staci, for having us on this obviously connected panel with direct lending. We're appreciative of it. And then thanks to all the people here. Having been in LA the last few days, the weather's amazing. The people are so chill. The fact that anybody is sitting here is extraordinary to me. So thank you very much. I think my kids would have left like at least, first 5 minutes or be on the phones completely. The connection, I used to be in this type of business, is actually not that hard to see. If you went back 20, 25 years ago, the leveraged loan business was actually in banks entirely. And the middle market lending business was entirely in banks. So what SoFi has done is taken super prime consumers and given them a non-bank alternative. I think just the quick commercial on the company, we're about 5 years old, 5.5 years old. I'm cheating. We always try to cheat. We've raised $1.9 billion. If you gave us $1 5 years ago, you've gotten 500x back. We're growing revenues about 100%, EBITDA about 300%. And all of those metrics, which are nice, adding 20,000 customers a month, none of those metrics really matter to us. Our business strategy is to try really, really hard to change the interface, the experience, and the bargain that customers get. And I think a lot of the discussion here will be about investors getting a better return. I've been talking all day, my apologies. Our board meeting was obviously a heck of a lot more charming. What we try really, really hard to do is how do we take cost out of the equation at every element, every quarter? How do we take capital cost out? How do we take processing cost out? How do we take customer acquisition cost out and plow that back into a better product and service? And if you were to make an analogy to Amazon, which we do because we're crazy and delusional and wishful, what we hope to do is to bring some of the forces that are going on in many of these industries where if winner doesn't take all, winner dominates, and bring some of those forces to improving products and services. So our value equation is slightly different. We're trying to bring investors an opportunity to experience super prime credit in our assets, much as my friends and colleagues on this dais have brought investors an opportunity to participate in middle market lending where they previously would not have unless they got it through a bank platform.
Okay. Turning back to kind of the mid-market company asset class, direct lending asset class, where exactly is this return coming from? I mean, you can get kind of almost 600 basis points of levered return in this asset class. So can you unpack exactly where that return is coming from versus liquid markets, and how do you compare? Maybe Tara, I'll start with you.
So when I worked at my old great firm, Wells Fargo, I remember we would equity allocate every risk position in every asset. For us, we generate assets that yield from 3 to 14%. That really isn't the critical factor. I think it's like Bridgewater's all-weather fund. We try to find the equity allocation and drive to an ROE that when we originate the asset, it's a 20% ROE. To be perfectly honest, we keep about half for the house, and we pass it on about half to investors. Okay. And that's the clearing level. And each quarter, we work hard to stabilize the return profile, but improve the investment and to the customer. So that's our math.
Okay, Terry, how about at Barings?
Yeah, sure. So in the middle market, direct lending can take the form of senior secured loans or mezzanine loans. In the senior secured loan market, the return comes from upfront fees that we realize as an originator, and those can range sort of 2 to 3%. We also benefit from contractual spread over the base rate because these are floating rate loans, and particularly right now in Europe, we benefit from base rate floors that actually exceed the prevailing sterling LIBOR and Euribor rates. So you put it all together, and we realize an all-in spread over the base rate that could be 150 basis points plus compared to the broadly syndicated loan market right now. So that premium, which I think compensates for a combination of the fact that private loans are a buy and hold security, so they're illiquid compared to, you can trade in and out of broadly syndicated loans. So you're being paid for the illiquidity, but you're also being paid for the complexity. Whereas you could buy a broadly syndicated loan from a trading desk, you have to go out and originate these direct loans. You have to have people on the ground in the local markets with relationships. And also the underwriting process is quite rigorous. It's somewhat akin to the due diligence associated with underwriting a private equity loan. So we're building bottom-up forecasts. We're on-site at the company. And so it's just a much more intimate process, if you will, and it's labor-intensive. So you're being compensated that 150 basis points plus premium for a combination of that complexity and the illiquidity.
So Damien, I'm imagining that without a private equity kind of a component, it's even more complex. And so are you getting paid even more for even more complexity?
We're not getting paid for complexity so much as we're getting paid for a supply-demand imbalance. The fundamental injustice for the families, founders, and entrepreneurs that we finance is that the system conspires against them. So if you are a successful family with a $25 million EBITDA business that is growing and you'd like to borrow $100 million, you don't get the same treatment as someone who happens to be owned by a private equity shop. Or when you just slow down and say, well, what's the use of proceeds? What was the catalyst? Why did the family need the money? the sensibility that there are partners available who are empathetic and listening and able to add value beyond just dollars, the system has evolved to a place where there are just not a lot of firms positioned to do that. And most families, as you can imagine, are not interested in transactions. They don't want a transactional relationship. They actually want someone who's going to be a partner. And it's especially important in our business because at Brightwood, we actually take covenants. And as has been discussed here at the conference, the broadly syndicated loan market, as it sits today, is covenant-free. There are no covenants. This is below investment grade debt. So our ability to force a conversation when things go bump in the night and to actually partner with our borrowers to navigate these tough waters, it's different. And that leads them to have a different decision tree when they're picking a lending partner. So we win and we're able to charge a lot, less because of complexity and more because of the environment in which we find ourselves at this point in the credit cycle.
Yeah, Mike Milken is always threatening to start a PICS Anonymous support group for folks. But Mike, first, do you have sort of anything to add to that in terms of market evolution versus sort of return? And
It sounds niche-y and interesting, but I don't really understand the difference between a family borrower and a private equity borrower or a real asset. I think that I would agree that there are non-financial components to a borrowing relationship on both sides of the table that always factor in, but I do think that particularly as the markets evolve, this is a financing transaction. We could call it whatever we want, but there's a limit to what people will pay you for all of the qualitative stuff. So I respect the experience. We've had it with some of our borrowers too, but I do think that we have to acknowledge the markets are evolving. There are more people every day that do have the ability to provide $100 million of capital, and you have to keep trying to find ways to differentiate yourself, either in the way that you approach your relationships or the products that you bring to your clients. But over time, it's going to have to be a whole combination of things, both financial and non-financial, to carry the day, because I do think these markets are evolving. You know, you talk about covenant light. If you don't want to buy covenant light syndicated loans, you're basically saying that you don't want to lend to the 30% best borrowers in the market. So you are making a credit decision fundamentally about the types of borrowers that you want to lend to. So viewed through another perspective, the syndicated loan market just transitioned to be a floating rate unsecured bond market in many respects. And if you think about the way capital continues to evolve and allocate into these markets, one could argue that we'll see that kind of evolution in the middle market as well. You know, where managers like ourselves are managing liquid and illiquid credit business alongside each other, and where our larger global institutional LPs are making much more rational and much more frequent relative value decisions between liquid loans and illiquid loans and high yield bonds and private high yield. And so as those decisions become more efficient and as the market mechanisms evolve for people to actually act on them, some of this social premium or relationship premium has to come out of the market, just because people are going to be moving money in and out, liquid and illiquid, I think, in a way that we haven't seen before.
Yeah, I just have to interject that that sounds great. The issue is the cost of origination for all these assets is really high. And fundamentally, the sponsor lending model is predicated upon having a list of PE shops you can call. That's cheaper and easier than actually having relationships. And where the rubber meets the road is, how does one do this at scale in a $1 trillion asset class? Which is why if you actually study the asset growth of most lenders, it's not as rapid as people might think. There are a lot of people asking for money to do this, but in lower middle market lending, it's hard to grow your business because it's hard to originate. And if you get into the weeds of what it takes to actually serve a borrower on a repeat basis, whether it's owned by a private equity shop or a family, there are a lot of nuances to that. There are a lot of nuances to it, and the cost of capital is just one component, but it's actually not the whole story.
I was speaking a bit, I was just going to make a comment directly to Mike's point around just this evolution. And earlier this morning, you had some of the largest fixed income managers sitting on a panel all around, return and where is return today. And the amount of dialogue, that panel switched directly to talking about direct lending. And, that wouldn't have happened a few years ago, right? And so you had everyone up there talking about that play between the high yield bond market and going into direct private credit. And what are the warning signs, right, to be quite candid as it relates to infrastructure build out and need to be thoughtful around direct origination versus taking leftovers and making sure you're diversified from the sponsor perspective so you're not being held hostage with just a few sponsors, which I think are important aspects as we think about as a lender. But I found it very interesting, encouraging, and definitely an evolution of this asset class for that to be the topic of discussion with some of the largest fixed income managers in the market as they were thinking about where they were finding value.
I just sorry to interject, back to what Nino said too, and there's still a long way to go before direct lending becomes a fully efficient market. So I wholeheartedly agree with Damien that there are nuances to how you originate and manage it, and it is very resource intensive, but like all maturing capital markets, and Nino hit the nail on the head, by definition, the return comes down, and in order to deliver a value proposition to the client, you have to be able to source and manage that asset cheaper without sacrificing performance. And we're so used to thinking about private credit as a much nichier global asset class than it really is. And my only point is I think we have to appreciate that the long-term forces in this market are going to probably develop along the lines that we've seen other financial markets develop, which is it'll move to scale, it'll move to global providers, and those providers will have to create competitive advantages and efficiencies in people and capital while maintaining performance. That I don't think that our business is any different.
Yeah, I was talking to Tom Fink, who's the CEO of Barings, of course, and he said, the thing is, I don't pay Terry based on the number of deals he closes every year, right? So it's just a very different relationship because you're in it for the long haul.
It was helpful, right?
Yeah, exactly.
No one told Terry that.
But Terry, let's talk about this as an asset class. How do you think about relative value, and how do your talk about your investors as well. How do your investors think about this as an asset class, and what structurally is happening there for you guys? Is it the fixed income department that's buying? Is it the alternatives department that's buying? Where are the buckets?
Yeah, sure, Staci. So, first, I appreciate Tom's comment. I think what he means is, look, this is a buy and hold asset class, and there's been a lot of discussion so far about, what is the premium return, but you can't talk about return unless you talk about the risk side as well, right? And so we did touch on briefly, and Damien mentioned specifically financial covenants that are embedded in the structures. So, all things being the same, you would think financing middle market companies might be riskier than financing larger companies, but all things aren't the same. We have the presence of financial covenants, the deals are more tightly negotiated, and the leverage structures are more conservative. That together with, with tighter lending clubs that can get together and decide what to do if a company underperforms helps to mitigate the risk. So that leaves you with the return premium that we talked about earlier. And so investors, whether they're looking at this asset class from the perspective of fixed income, and more we're seeing investors, particularly in Europe and across Asia and Australia, beginning more to consider private credit as an illiquid sleeve of the fixed income asset class, or whether you're looking at it as an alternative asset, focusing on the illiquidity. I think investors are attracted simply due to this premium return opportunity. But I also think that they're beginning to realize more and more that it's also a diversity opportunity. So if you think about the types of risks that may be faced by larger issuers, whether they're public equity businesses or whether they're issuers of broadly syndicated debt, you think about some of the risks. that they may face, whether they may be involved in exporting, and perhaps there's a risk of a stronger dollar if you're a U.S. exporter, or perhaps you're in heavy manufacturing and you're importing and you're concerned about the border tax or what variation on that theme evolves from the process that we're seeing take place right now. But middle market, I think middle market borrowers also have somewhat different credit characteristics, and I do think that investors are beginning to appreciate that well, that it's an opportunity to diversify as well.
Okay, so I want to start talking about the future and regulation and where you think the market is and the health of the underlying and all of that. But I just want to go quickly right down the row and ask you, in your markets, do you think, are we in a frothy market, or is this just a maturation phase, or where do you think we say? Is there dumb money coming in and making things difficult for everybody, or is it just a sign of a maturing asset class?
Clearly, there are new entrants coming into the asset class. I mean, to me, the ultimate test is the risk-adjusted return attractive, which would be an indication of a degree of equilibrium in the markets. And we do believe that the risk-adjusted return is attractive right now for private credit. But again, particularly like in the European market, so in the private debt market in the U.S., for quite some time, the market's been dominated by private debt providers versus banks. European market's just the opposite. You are seeing new lenders come in, but I do think there's still a pretty good degree of equilibrium between supply and demand in that market.
Nino, you've never seen a downturn? I mean, personally, I'm sure you've seen
Unfortunately,
many
I felt a downturn. I mean, the way I would respond to your question, it's, regardless of what we're talking about, it's really the best year overall in markets in a decade. Things feel really, really solid. I think there's two elements to that. There's frothiness, and then we remember 9-10 years ago, fragility. So things are fully valued, but they don't seem fragile. They don't seem unstable. For our industry, we have not. You're right, there hasn't been a downturn, but in the last 5 years that we've been in existence, we've been in the same 5 years that everybody else has, and our student loan loss rates have been 4 basis points per annum. Our unsecured consumer or unsecured personal loans in the high 100s on a 10% coupon, and we don't have a loss on our mortgages at all. So all you can do is exist in the same environment that everyone else is. I think that the last financial crisis has really made people a lot more wary of liquidity and fragility, and it feels to me, if I think here what we see on loan demand, it feels that loan demand is going to remain really quite strong for all of these asset classes for the imaginable future. I think demand for assets exceeds the supply, and that doesn't seem to me an unhealthy constraint on growth.
How about for you, Nino?
So it's interesting. I think simplistically, the asset management business has changed a whole lot more than the credit cycle, and we shouldn't conflate those issues. Since the great financial crisis, all of us have performed in a benign credit environment. What has changed, however, is the asset management business has grown up. And we're seeing fee compression across the board. 2 and 20 is dead.
Yeah, grown up, by the way, is a euphemism for not good.
Institutional investors, specifically pension funds and insurance companies with low cost of capital, have identified an asset class that could generate double-digit net returns on a levered, sometimes unlevered basis. But the quid pro quo is they will write large checks but for lower fees. That's changed within the asset management business. That does not change in the credit cycle. And therein lies the danger. We all wonder the day and time when we will have another proper credit cycle. And interestingly, at Brightwood, we talk about it internally. We don't reflect on the great financial crisis as, in fact, a credit event. We think it was a liquidity event. We think there was asset liability mismatches system-wide, and there's a margin call on the system. But if you actually think about the entrepreneurs that we finance, and you look at their 10-year audited financials, and in our business, most of our borrowers have 15-year or longer operating history. There's a lot of data that shows how these businesses can perform in good times and bad, and that they are, in fact, conservatively capitalized. But their access to capital is not consistent. And now that the asset management business has really taken up credit holistically for a variety of reasons, I think the conversation is less about the credit cycle, more about how our industry is changing.
Yeah.
You know, I think you're spot on, and I think those are excellent points. You know, as we look through to, you know, the question around is frothiness there, and do we see something coming? You know, the way we lend to our asset manager and finance company clients is, as I mentioned, bottoms up. So we're looking at the underlying credits on a loan-by-loan basis, and for lack of a better term, re-underwriting our clients' underwriting. And fundamentally, the borrowers look, the underlying borrowers look very strong, right? I mean, so we're not concerned about any level of decline in EBITDA or changing landscape. Now, there's pockets where we are, right? So certain industries and idiosyncratic risks that you might find. I think that we have definitely solved a lot of that mismatch in liability and asset with longer duration lending. It's on the forefront of every manager's mind, I feel like, that we talk to. And the investors, interestingly enough, that we're speaking to are sophisticated. Back to Damien's point, the folks that are coming into this space. So one of their first questions is, how do I think about that asset liability mismatch? What might happen if you don't roll your debt facility? You know, what have you seen in the past, and why did folks exit this asset class in the downturn? So I do think all the right questions are being asked, but we have to think about what the behaviors are. It feels like leverage is a bit toppy, but we also have to think about that as a supply-demand dynamic. The M&A calendar was very small in the first quarter, and you know, some of that is not atypical in that environment to see a creep there.
Mike, I want to ask you about frothiness, but also just playing off of Katherine's last observation. You have big scale, and so you have a lot of data. You see a lot, and are you seeing in the underlying top-line growth, or is the EBITDA just kind of cost savings and cost efficiency? You know, paying your loans back and on time is not really the same thing as growing a company. So how do you think about that? And are you?
I think most everybody in this room knows that the fundamentals are strong, but the growth rates are deteriorating. Mm-hmm. So typically when you're this late in the cycle, you actually see earnings recession, and I don't think we're seeing that across our liquid and illiquid portfolios, but we are seeing the rate of growth slow. And I would agree with Damien. I think that most of the downturns are liquidity induced. The issue I see is everything that is getting booked now is with a view that the fundamentals are strong, which they are, but it is absolutely priced to perfection. So when you look at company business plans and the ability to service debt, it is priced to perfection from an execution and operational risk standpoint. So there is very little margin of error, in my opinion, for the underwriting that is going on now looking forward. And so part of what you have to do as a manager is ask yourself, would I rather book a loan today, or would I rather book a loan 6 months from now, and what's the probability of the market changing and offering me a better risk-adjusted return opportunity 6 months from now or today? But generally, things are healthy, which is why it's a frustrating investment environment, because typically when you're 9 years into a cycle, you're seeing much weaker credit performance in your underlying book than you are now.
Okay, I want to talk a little bit about the regulatory environment and what we can expect and how you're preparing for that, and also just how you're thinking about how your market segments are going to react in a potentially rising interest rate environment. And then after I do that, we will turn to questions. So I think there's a couple of mics, and do get ready if you want to ask one. But so I can't really decide if you're happy or not with this president and the kinds of noises he's been making about regulation, because on the one hand, If regulation kind of gets eased up, are the banks going to come back in to your sandbox and start, eating your business? But on the other hand, will a regulatory framework that gets more onerous start coming after you in the way that it went after banks? So I don't know how you're kind of thinking about that. And I think this president is not sort of pro more regulation, but he has talked about things like removing the interest deduction. So I don't know how you all think about that and how scary that is to you. We are in a rising interest rate environment, and so how do you think about that? So I'll just toss that out to anybody that wants to kind of take it for their, okay, Nino?
Yeah, I'll start. I mean, I think our our perspective on the regulatory environment was that it was generally, I believed, a well-intended series of actions that had very little result in creating good outcomes. We're certainly rooting for every business and consumer in the United States to face less unnecessary regulatory burdens if that makes our business more challenging, because it'll be easier for some of the large banks. I think that that's just and right. It'll help consumers. I think it's been, and small businesses, I think it's been a sad tax that has had really little effect. And we believe that the current environment will be better. And I think that that's much of the confidence you see in businesses, is that at the very least, it won't continue. The beating on the head will stop.
I'd make one. I think part of the challenge that we have is we're trying to decipher language that's coming out of the administration. But if you really think about the issues facing the banks with regard to regulation, we have not heard anybody say that the regulators are stifling people's views on risk or asset strategy. What we are hearing is that it is meaningfully compromising the ROE opportunity within banks without positive effect. So depending on the medium to large bank CEO you talk to, I think they'll tell you that the cost of regulatory compliance is probably running somewhere between 400 and 500 basis points of ROE. And if you have a banking market that's in the high single digits, if all that happens is regulations become simplified, easier to understand, less costly to comply with, coupled with rising interest rates, you can see the ROE opportunity within banks meaningfully go up 40, 50% with no change in asset strategy. So I think that's important as we talk about this, because no one's saying, I want that 500 basis points, and then I'm going to staff up with 300 people and go make middle market cash flow loans. I just don't think that that's how people are thinking about it. And in some respects, the news that came out yesterday, which wasn't actually news, that Glass-Steagall for the 21st century is kind of back on the table, gives a little bit of perspective that I think what people are trying to angle for is more simplicity, more transparency, less cost, but not necessarily more risk-taking. So from my perspective, most of the conversations around bank and financial services regulation are about how to have people take more prudent risk with more transparency, and promote capital formation, but not change the way that folks are doing things. And all of the conversations about regulatory rollback are actually coming with a spotlight on increased Tier 1 capital requirements. And there's a little legislation internationally called Basel III that's not going away, that drives bank behavior regardless of what we decide that we want to do within our own banking system. So sometimes it seems like those two things are in conflict, but they're actually saying the same thing, which is no one wants banks to be riskier. They just want them to be more efficient and have the opportunity to make higher ROE doing what they do best. And that's actually good for our business. So I don't see it as a big risk.
Yeah, Mary Katherine, you have limits on the amount of levered loans that you can have on your balance sheet, but you are lending into these leverage vehicles. And how do you kind of manage that with regulators? And what do you, that shadow banking kind of role?
Right.
You know?
Yeah, I mean, we definitely include all of the business that we do as a reportable item around, the underlying is leverage loans. We're very frequently in dialogue with the OCC and Fed and each of the regulators around what the underlying is. Most of the processes and procedures that we've built in our business around the asset level bottoms-up analysis I believe gives them comfort, right? And so I'll say that with at least the last time they were in, they were comfortable. And so things can always change. But there is a significant amount of work going on right now in evaluating how banks lend to non-bank financial institutions and what are the policies and procedures. And, I would say that we feel very good about how we are lending in this space, and we're not concerned about that for all the reasons. I very much agree with Mike. I think, again, back to the point around this is a safer, better risk-adjusted return for us as a bank institution to play this market. If that came out of the regulation, maybe that's not a negative, right? At the end of the day,
That's maybe the intention as well.
And going back to even the Greenspan Fed, everybody said we want assets to move through the banking system and get distributed into the market in a way that doesn't create systemic risk. So the fact that we now, to Damien's point, if we think that we have a $1 trillion or $2 trillion addressable market with market leaders having less than a 1% market share, that seems to me like the job has been accomplished, which is that the risk has moved into the system and gotten broadly distributed to sophisticated investors who are better positioned to evaluate and take that risk than a regulated entity. So I think in many respects it's worked.
Damien or Terry, do you want to say anything about this before we turn it to audience questions on the regulatory or the
Yeah, I would agree with everything that we heard from Mike and Katherine. That's no fun.
Disagree with something?
But I would go back to the point that I made earlier that the direct non-bank lending market has been evolving for quite a long time in the U.S. market, and it was quite well evolved even before Basel III and Dodd-Frank. And so while we do get a question from investors, how is this going to impact our market, we do believe that I think the private debt market's probably gonna remain on solid footing.
If you think about the balance sheet of an asset manager, the regulatory pressure is going to be on the right side, not the left. So the question is, how are asset managers raising money? How are they treating their clients? As noted before, we are in a declining revenue business, asset management holistically. The unit economics for asset managers are declining, they're not going up. And some of the sales practices that have been enacted by certain firms have been poor at best, and the government is paying attention to it. And that's not going to change. We also know we're probably
I assume you're not referencing Wells Fargo.
No. The present company is always excluded.
We also know we are in unprecedented times where for the last 20 years, non-bank lenders have stepped up to take on this capacity, but the way the government was able to think about and regulate those entities was at best unclear in the early years and is just now starting to evolve. So I think the regulatory pressure is on how do you raise your money and from whom? I think on the asset side of the equation, as Mike points out, the reality is that the intentions of the regulators, it's worked. The challenge is most entrepreneurs feel like they don't have enough access to capital, so the money's not moving. And so maybe the regulators had a bad idea with some unintended consequences, and it's inured to the benefit of certain asset managers, but even there, the regulators are coming, and the business is getting better every year, but clearly there are issues that still have to be ironed out.
Okay, if I see some hands go up quickly, I'll take them. But if you pause too long, I'll just keep going. Okay? Just no pontificating, just the question.
I won't. My name is Melody Barlins. How well do you think your investors understand the risks of this asset class?
Okay.
Both on the retail side and the institutional side.
Okay. Another question? I'll take three. If I behind you.
So regulations came into play after 2008, pretty big. There was a reason for that. Capital now has flowed from the banks to now, the direct lending groups, kind of circumventing to a degree those regulations, if you will. What are your thoughts on the risks there?
Okay. Yep, and last question.
What are the this may be for Mary Katherine, what is the specific regulatory inhibition from you coming in with your much less expensive capital and better leverage to just wipe everyone else out?
Oh, Mary Katherine, why don't we start with you?
So, that sounds very powerful. So, I mean, and when we think about everyone else, what Mike would tell you is we're not the least expensive. So he would say that's not going to work. But I think at the end of the day, the importance for us is that enhancement, right? That's coming from the manager. So that to take and disintermediate the non-bank lenders would be very challenging for a bank to do. At the end of the day, to be honest, that from a cost of capital perspective, I actually don't think it works that well in the form at the direct lending level for the bank. There's places where it does, like asset-based lending is from a risk rating perspective at the bank level and how we think about recovery rates on that paper and so forth. That becomes a very attractive capital asset for us as long as we can get the utilization correct. But on a true cash flow leverage loan, it wouldn't. And so I think that we won't take these folks out of the market. And as Terry was saying, even prior to the leverage lending guidelines, you were seeing a shift, a pretty large shift from much of this lending out of banks into the non-bank finance companies. And there's just been a continued growth of that since.
Okay.
I think clients understand the risk. I think their question is how much of the risk can we generate? I believe clients perceive us taking single B risk, charging triple C prices, and applying leverage. Question is, as we aspire to generate 1.4x MOICs, 10, 12% net IRRs, can we do it at scale? Can we do it consistently? And when we have inevitable credit cycles, can we make sure we still get their money back? So I think the question is about origination, not about risk. I think clients get the joke on risk. Most of us are trying to create single B profiles, LTVs in the 50 to 65% range from growing companies. It's just tricky to do it at scale.
Yeah.
Oh, I do, however, think that private debt providers approach the market in different ways, and that does create some degree of confusion in the market with investors, even institutional investors, because there are those who not only do they play in different parts of the capital structure, but their appetite for risk is different as well. So there are lenders who are more focused on performing steady credits and others who are looking for more yield, but willing to finance companies with a bit of a spotty history, more story credits. So I do believe that that does create some confusion in the marketplace, but institutional investors, they do their due diligence. It's just key to understand the manager with whom you're looking to invest.
Any responses to that?
Yeah, no, I mean, I think that our investors are extraordinarily sophisticated, and the markets clear out folks that are not. They tend not to get a tremendous amount of capital. 99.9% of our investors, everybody here would know all of their names. And I think the system works pretty well about them understanding the risks and rewards of our business.
Okay, now you've all read the sign at the front of the conference. This is about how to build a meaningful life. So I am going to go down and ask the panelists in a kind of a final bullet round what they think constitutes a meaningful life. I think they'll never be on another panel with me again if I do this. But
I hope you're going to start at that end.
I'm going. I'll start at that end. But before I do that, because I know that Mike Arougheti and Terry Harris would never do this. So I'm going to ask you, Damien. Mike Cagney got up on the main stage yesterday and said that SoFi is really a full-service operation in the same way that you've declared yourself kind of a full-service operation to your borrowers. And Mike said, we want SoFi borrowers to meet each other and mingle, and maybe they want to date, and marry each other. And I was wondering if you actually provide as well that kind of dating service overlay for the founders of your companies. I don't think Mike does that, but maybe there's a shot with Brightwood.
So we've financed 100 companies over $3.5 billion in the last 5 years. I've spent time with a lot of CEOs. And what I know about CEOs is that they tend to be lonely, a little bit stressed out, and one of the services that they enjoy is at the margin some marriage counseling and a hug.
Okay. Perfect. Okay, any thoughts on a meaningful life?
Oh, boy. I think for me, number one, you have to truly enjoy what you do, and you have to show up and be passionate about what you do. And back to, I know I was giving Damien a little, but I do think you have to approach your life with a real view that you want to build lasting personal and human relationships with the people that you're interacting with, whether that's in your business, but to approach it with dignity and integrity and respect. And I think sometimes in our business, we do make it too much about the money and the transaction. I just think that it's so much more fulfilling if you start with the human element first and then bring the economic stuff second, because that tends to follow.
Okay, all right, Katherine.
Yeah, no, I mean, I think it's all about the team, and I think the team is your team members that you work with every day that are part of our own company, the team members that are clients that, they have to be our partners and team every day to make the relationship and a facility work. And then, for me, the team members are at home too, and so it's my family and my children, that kind of drive me every day too. So it's all pieces together. They don't always work together on the same day, but we hope they do.
Damien.
Be generous.
All right. Okay, Nino.
That was succinct. I assume this is a professional one. I think I'd make 3 specific comments. One, in your life, try to work as often as you can in a growth company, in a growth industry. It's dynamic, it's exhilarating, it's painful, it's fun. Second, I'd say try to work most of your life. I've spent 75% of my life working in a private company, because the coolest thing is you can pick your owners. And we've been blessed at SoFi with SoftBank and Masa, who's an inspiring guy. But in previous life, I've had that same enjoyment. And then the third, and what I think is most important, be fortunate enough to work with young people that absolutely inspire you. I think I have a half dozen folks that are 27 to 36 that they are smarter, more interesting, funnier, and they tell me more attractive than I've ever been. And they make work unbelievably fun. If you do that, I think you're going to have a heck of a good time.
Okay.
I could say that my life would be more meaningful if Tom Fink would pay me more for doing more deals, but I won't. It's really just making a difference in the lives of the people that, with whom you come into contact every day. And I've had the pleasure of building businesses throughout my career. It's always been in the financial services industry, and I've enjoyed nothing more than seeing the young people who we train grow up in the business and buy houses and send their kids to college. That's what's done it for me.
Okay, please thank my panelists for an amazing panel.